Welcome to Talk Tickers. Today is Saturday, February 21st, 2026. And usually we're here breaking down the quarterly earnings for the heavy hitters, you know, your NVIDIAs, your Apples, the companies that really move the S&P 500.
Right, the big market movers.
Exactly. We spend a lot of time analyzing their balance sheets, their forward guidance, their cash flow. But today we are doing something a little different. We're looking at the ultimate earnings call, the one where you are the CEO, CFO, and the sole shareholder.
It is the balance sheet of your life, basically.
Yeah. We are talking about your retirement. And it's the only earnings call where you can't just issue a press release and hope for the best.
No, you really can't. I mean, the market does not care about your strategic pivot if you run out of cash.
Exactly. So for this deep dive, we are looking at the single most critical equation in financial planning. It's the transition that literally keeps people awake at night because you spend 40 years climbing the mountain, right? That's the accumulation phase.
The saving phase.
Right. You save, you invest, you dollar cost average into your 401k. You just watch the number go up. But then you reach the summit, and anyone who knows anything about mountaineering knows that the climb up isn't really where people die. The descent is where the danger lives.
That's a perfect analogy. The climb is just physics and effort, but the descent is about survival mechanics. In financial terms, we call this the shift to decumulation.
Decumulation, right.
You stop earning a paycheck, stop adding to the pile. Instead, you have to start liquidating those assets you spend an entire lifetime building up. And the stakes just couldn't be higher.
Because if you miscalculate the descent,
you run out of oxygen. Or in this case, you run out of money before you reach the end of your life. That's what the industry calls longevity risk.
But there's a flip side to that too, isn't there? Because I know plenty of people who are so terrified of falling that they basically starve themselves on the way down.
Oh, absolutely. They die with a massive surplus that they never even enjoyed because they were just too scared to spend a single dime.
And that's the regret risk.
Just exactly. Regret risk. Dying with the richest graveyard plot in the cemetery. So the entire goal of financial planning is to thread that needle. You want to spend enough to enjoy the life you built, but not so much that you end up greeting customers at a big box store when you're 85.
Right. And for the last 30 years, there has been this Sherpa guiding us down the mountain. It's a heuristic known as the 4% rule.
The holy grail of retirement planning.
It really is. It is arguably the most famous number in personal finance. The idea is simple. If you have $1 million, you can spend $40,000 a year, adjust it for inflation, and you'll be totally fine. That's the gospel.
It's written in stone in basically every finance blog from 1998 all the way to today.
But here we are in 2026. We're living under this massive shadow of uncertainty regarding fixed income equity valuations are historically high. And frankly, people are just living longer than ever.
A lot longer.
So the mission of our deep dive today is simple but terrifying. We need to figure out if the 4% rule is an ironclad law of retirement physics, or if it's just a statistical fluke based on a very specific, very lucky period of American history.
Yeah, we are going to tear this rule down to the studs today. We aren't just going to define it. We're going to look at the actual mechanics of why it exists.
The math behind the magic.
Exactly. And we're going to look at the international markets too. What happened to the 4% rule in France or Italy or Japan?
Spoiler alert, it gets ugly.
Very ugly. We're also going to talk about the silent killers of wealth that the original studies completely ignored, specifically taxes and fees. And finally, we're going to look at modern adaptations, things like guardrails buckets and the new math for 2026.
It's a complete stress test of the safety net for the American retiree. So let's just unpack this right from the start. I want to look at the history because the context really matters here. This rule didn't just appear out of nowhere. It was a reaction to a very specific problem.
It was.
Because before the early 90s, retirement advice was, well, let's call it overly optimistic.
Optimistic is a very polite way of putting it. It was honestly dangerous.
Yeah.
It was this era of linear thinking. You have to remember, in the 80s and early 90s, yields were incredibly high.
Stocks were booming.
Exactly. So a financial advisor would sit down with a client, pull out a calculator, look at the historical average of the S&P 500 and say, well, historically, the market returns about 7 or 8% after inflation.
Seems reasonable.
Right. So they'd say, Mr. Client, you can withdraw 7 or 8% of your money every single year, and you'll never even dip into the principal. You'll just live entirely off the growth.
Which honestly sounds incredibly logical on a spreadsheet. I mean, if I make 8% and I spend 8%, I still have 100% of my principal left at the end of the year. So why was that so completely wrong?
It fails spectacularly because the market doesn't actually give you 8% every year like a steady paycheck. The market is a manic, depressive beast. One year it gives you 20%, the next year it takes away 15%. If you are withdrawing 7% to live on and the market drops 20% in your very first year of retirement, you aren't just dipping into your principal, you are actively devouring it.
You are digging a hole that the math says you can basically never climb out of.
Exactly. So enter Bill Bengen.
Right. This is 1994. And
Right.
Bengen isn't your typical Wall Street guy, is he?
No, not at all. And that is exactly why he was the perfect person to solve this problem. Bill Bengen was originally trained as an aeronautical engineer.
He had an MIT background, right?
Yeah, an MIT engineer. So he approached retirement planning not like a mutual fund salesman, but like an engineer looking at structural failure loads. He looked at the advice being given out, that 7 or 8% withdrawal rate, and his engineering brain just flashed red. He basically said, this is going to crash the plane.
So he decides to actually stress test it.
Right. He built a massive data set. Instead of asking what works on average, he asked what happens when absolutely everything goes wrong.
The worst case scenarios.
Yes. He looked at rolling 30-year periods in U.S. history, starting from 1926. He looked at what happened to someone retiring in 1929, right before the Great Crash. He looked at someone retiring in 1966, right before the massive stagflation grind of the 70s.
He was looking for what we call the safe max.
Correct. This is the safe max. He wanted to find the maximum withdrawal rate that survived the absolute worst financial storms in U.S. history without the portfolio hitting zero.
So he wasn't trying to make people rich.
No, he was just trying to find the floor where they wouldn't die poor.
And what did the engineering stress test actually reveal?
It revealed that the safe number wasn't 7%, it wasn't 6%, it wasn't even 5%, it was roughly 4.15%.
Which he just rounded down to 4% for simplicity.
Exactly. He found that if you used a portfolio of roughly 50% stocks and 50% intermediate-term government bonds, a 4% initial withdrawal rate survived every single 40-year period in U.S. history.
That is just wild. So even if you retired the day before the 1929 crash, if you stuck to the 4% rule, your money lasted 30 years.
You made it.
Yeah.
Now, you might finish your 30th year with $50 left in your checking account, but the final check didn't bounce. You didn't run out.
Survival.
Just survival. And in most other historical periods, say if you were retired in 1950 or 1980, you didn't just survive. Because you started with such a conservative number like 4%, the bull markets eventually just took over, and you ended up dying with 3 or 4 times your original wealth.
Okay, so that's the origin story. Now, I really want to clarify the mechanics here because I think a lot of people just get the fundamental algorithm of this wrong.
Oh, they definitely do.
When we say the 4% rule, people naturally hear withdraw 4% of your account balance every single year.
That is by far the most common misconception. If you did that, if you withdrew 4% of the current balance every year, you would technically never run out of money.
Because it's mathematically impossible to hit zero if you're always taking a percentage of what's left.
Right? You just take smaller and smaller slices. But your standard of living would be an absolute roller coaster. If the market drops 50%, your income drops 50%.
And you can't exactly tell the electric company, hey, sorry guys, the S&P is down, so I'm only paying half my bill this month.
Exactly. The electric company doesn't care about your portfolio drawdowns.
So walk us through the actual Bengen method. Let's use a round number. Say I retired today, February 23, 2026, with exactly $1 million.
Okay, step 1, you calculate your initial withdrawal. 4% of $1 million is $40,000. That is your paycheck for year 1.
Simple enough. Now let's fast forward to February 2027. The market has absolutely crashed. My $1 million is now sitting at $800,000. But inflation's been running hot. Let's say it's at 5%. What do I do?
This is the key part. You completely ignore the $800,000 balance. You do not look at the portfolio value at all.
I just pretend it didn't drop.
You pretend the drop didn't happen for the sake of your spending. Instead, you look at the inflation rate. You take your year 1 withdrawal, which was $40,000, and you give yourself a raise to match inflation.
So $40,000 plus 5%.
Which is an extra $2,000. So in year 2, you withdraw $42,000.
Even though my portfolio is down 20%, I'm taking out more money.
Even though your portfolio is down, you take out more money. The entire goal of the rule is to maintain your purchasing power. You want to be able to buy the exact same amount of bread, milk, and gasoline in your 30th year of retirement as you did in your very first year.
So the portfolio is just the engine room trying to keep up with that demand.
Precisely. It is a constant spending power strategy. And you just do that every single year. You take the prior year's dollar amount, slap the CPI number on it, and cut the check.
And for the U.S. history that Bengen studied from 1926 through the early 90s, that specific method worked 100% of the time.
100% of the time, yes.
But you just said for U.S. history. That's the phrase that really catches my ear. Because this is where the cracks start to form in the narrative. We've been treating the U.S. market performance of the 20th century as normal. But was it normal?
Not at all. And this brings us to the first major critique of the rule, which is the flaw of U.S. exceptionalism. When we base our entire retirement strategy on U.S. market history, we are engaging in a massive survivorship bias.
Because the United States in the 20th century was a total financial anomaly.
It was a superpower that essentially won the lottery. It won 2 world wars. It escaped the physical destruction of infrastructure that completely devastated Europe and Asia.
Right. No bombs dropping on our factories.
Exactly. Plus, it had a massive technological boom, highly favorable demographics, and the rise of the global consumer class.
We were the winning ticket.
We were the winning ticket. And if you plan your retirement assuming you will always hold the winning lottery ticket, you might be taking on way more risk than you actually realize.
So let's look at the data outside the U.S.
There was this fascinating study done by a researcher named Wade Pfau, who looked at this from an international perspective. He didn't just look at the U.S. He analyzed 17 developed countries over a 109-year period, from 1900 to 2009.
And let's be clear about the list of countries Pfau analyzed. We aren't talking about unstable emerging markets here. We are talking about the absolute titans of the 20th century. The UK, France, Germany, Japan.
Right. If you were sitting in a cafe in Paris in 1905, you would have considered France a financial superpower.
Oh, absolutely.
You would have felt just as safe investing in the French stock market as an American felt investing in New York. And that is exactly what makes this international data so deeply unsettling. Pfau took that safe 4% rule, the one that worked perfectly in the U.S., and stress tested it against the reality of being a French or Italian or Japanese investor.
And the report card was, well, it was not good.
It was an absolute bloodbath.
Okay, give it to me straight. How many countries survived?
Out of 17 developed nations, the 4% rule only survived the 30-year test in 4 of them.
Wait, just 4. So in 13 major global economies, if you tried to spend 4% of your portfolio, you went broke before you died.
You went broke. And in many of those cases, you went broke very fast. Canada, Sweden, Denmark, and the U.S. were the only survivors. Literally everyone else failed.
Let's dig into a specific failure because I think abstract numbers sort of hide the pain of what this actually looks like. Let's talk about the Japan scenario. And I don't mean the 1989 asset bubble. I mean the World War II era.
This is by far the most terrifying counterexample. So imagine you are a Japanese retiree in 1937. You have saved diligently your entire life. You have a perfectly balanced portfolio of Japanese stocks and government bonds.
And you decide to apply the 4% rule.
Right. Well, within a few years, the war completely destroys the industrial base, which crushes your stocks. Then post-war hyperinflation kicks in. Prices double, then triple, then quadruple.
But your bonds are static.
Exactly. Your bonds are paying fixed coupons that are now practically worthless because of the inflation.
So your portfolio is just getting hammered on both sides. The stocks are down because the factories are gone, and the money you do have buys absolutely nothing.
And because of that, the safe max for a Japanese retiree starting in 1940 was 0.47%.
Less than 0.5%.
Less than 0.5%. That means to generate $40,000 of income, you would have needed a portfolio of nearly $10 million.
Wow.
If you tried to pull 4%, your portfolio would have been completely vaporized in a matter of a few years.
But, okay, that's total war. That's physical destruction of a country. What about somewhere like Italy or France? Did they fare any better?
They fared better than Japan, but it was still a failure. In Italy and France, safe withdrawal rates were often below 2 or 3%.
Still well below 4.
Exactly. And the issue wasn't always total war destruction. Sometimes it was just a period of prolonged economic stagnation combined with really high inflation. The larger point here is that the 4% rule silently assumes a very specific kind of economic environment. It assumes capital markets function well, the rule of law holds, and steady growth is the default state of the world.
So relying blindly on the 4% rule is essentially a bet on American exceptionalism continuing forever. It's a bet that the 21st century U.S. economy will perfectly mirror the 20th century U.S. economy.
It creates a massive success bias. We look at the survivors. We don't look at the markets that went to zero or faced catastrophic multi-decade drawdowns. And here is the craziest part of the international data.
What's that?
Even if we assume perfect foresight, meaning you could magically pick the absolute perfect asset allocation between stocks and bonds for that specific country in that specific year you retired, a 50-50 portfolio still failed the 4% standard in all 17 countries at some point during that century.
So even with a crystal ball, it still failed. That is a deeply sobering thought. But let's bring it back home to the U.S. Even if we assume the U.S. doesn't become 1940s Japan, there are still massive risks embedded in the math itself right here at home. We need to talk about sequence of returns risks.
Yes, the big one.
I feel like this is a term financial advisors just throw around constantly, but the average person doesn't intuitively grasp it.
It's counterintuitive. I like to explain it with an airplane analogy. Think of your retirement portfolio like a plane taking off. When you are accumulating money during your working years, you are on the ground. If the engine stalls, meaning the market crashes, it's annoying, but you are completely safe. You just wait for the mechanic to fix it.
You're just buying cheaper gas while you wait for the plane to get fixed.
Exactly. But the very day you retire, that plane takes off. Sequence of returns risk is the extreme danger of the engine stalling right after the wheels leave the runway.
Okay, I see where this is going.
If you lose your engine at 30,000 feet, which represents your 20th year of retirement, you can glide. You have altitude. You have a buffer.
Because the portfolio has had 20 years to compound.
Right. But if you lose the engine at 100 feet in the air, meaning a market crash in your first or second year of retirement, you just crash.
Yeah.
There is absolutely no time to recover altitude.
And this is exactly why average returns lie to us. You can have two different retirees. Retiree A gets a sequence of really bad returns early in retirement, followed by a huge bull market later. Retiree B gets a huge bull market early on, followed by a major crash later. Both of them might have the exact same average return over 30 years. Let's say they both average 7%. But retiree A goes completely broke and retiree B dies a multimillionaire.
All because of when the money was taken out. We call this reverse dollar cost averaging. When you are saving, a market crash is great because you buy more shares at a discount. When you are spending, a market crash is absolutely devastating. You are actively forced to sell your assets at severely depressed prices just to pay your electric bill.
Let's put some real numbers to this to make it concrete. Let's say I have $1 million and the market drops 20% in year one. Now I have $800,000. But according to the rule, I still need to withdraw my $40,000.
Right. Before the crash, selling $40,000 meant you only had to sell 4% of your total shares.
Okay.
But after the crash, to get that exact same $40,000 in cash, you have to sell 5% of your remaining shares. You are liquidating a larger and larger piece of the factory just to keep the lights on.
And once those shares are sold, they're gone forever.
Gone forever. So when the market eventually bounces back, and it always does eventually, those shares are no longer in your account to participate in the recovery. You have locked in the loss permanently.
We call this the vulnerability window, right?
Yes, the vulnerability window. The math clearly shows that the first 10 years of retirement are the critical decade. The sequence of returns you experience in that specific first decade explains roughly 77 to 80% of your final outcome.
Wait, 80%. So what happens in years 11 through 30 is almost irrelevant to whether you succeed or fail.
It's statistically minor. The correlation just drops off a cliff. Returns in the final 20 years of your retirement only explain about 5% of the success or failure rate.
That is wild.
If you survive the first 10 years without a major drawdown, your portfolio hits escape velocity. The compounding takes over and you're usually totally safe. But if you get hit with a 2000 to 2002 dot-com bust scenario or a 2008 financial crisis scenario right out of the gate, you enter an unrecoverable death spiral.
This is what some analysts call the waterfall effect. Your wealth is at its absolute peak on the exact day you retire. If the market drops immediately, you fall off the waterfall and you can't swim back up.
And this connects directly to market valuations. We have centuries of data linking the Shiller PE ratio, the cyclically adjusted price to earnings ratio, to safe withdrawal rates. When starting valuations are incredibly high, like they were in 1929, 1966, or 2000, the safe withdrawal rates historically tend to be much lower.
And where exactly are we today in 2026?
We are seeing very high, say, PE ratios. We have seen a massive run-up in the mid-20s. At the same time, the dividend yields are relatively low compared to historical averages. And historically speaking, high valuations and low yields at the start of retirement strongly predict safe withdrawal rates falling below 3%.
So the market signals are essentially flashing yellow, if not red right now. The engine is sputtering, just as a lot of people are trying to take off.
Definitely.
But there is another silent killer that the original Bengen and Trinity studies completely ignored, and this one is guaranteed to hit you regardless of what the stock market does. We have to talk about taxes.
Yes, this is the gross versus net fallacy. It's a huge blind spot. When Bill Bengen did his study, and when the famous Trinity study was published, they were looking at investment returns in a complete vacuum.
A perfectly frictionless environment.
Exactly. They assumed zero transaction costs, zero investment management fees, and most importantly, zero taxes.
So when they said 4% is safe, they explicitly meant 4% of the gross portfolio. But the grocery store doesn't accept gross returns. The grocery store wants net dollars.
Right. In the real world, you have massive friction. You have expense ratios on your mutual funds or ETFs. You might have a 1% fee you pay to your financial advisor every year. And then you have the IRS standing there with their hand out.
I really want to spend some real time here because this is where so many people get blindsided in early retirement. Let's do some napkin math. Let's say I need $5,000 a month to live my life. That is $60,000 a year. If I have $1.5 million in my portfolio, 4% is exactly $60,000. So I look at that and I think, great, I'm totally safe.
Hold on a second, though. Where exactly is that 1.5 million located?
Let's assume, like the vast majority of Americans, it's sitting in a traditional 401k or a traditional rollover IRA.
Okay, so that money has never been taxed. The IRS basically owns a giant lien on that account. When you withdraw that $60,000, it is treated as ordinary income.
So it's taxed exactly like a paycheck from an employer.
Taxed exactly like a W-2 paycheck.
So depending on my other income, I might be in the 12% or 22% bracket or even higher. Plus, I have to pay state taxes depending on where I live.
Right. So let's just say your combined effective tax rate is 20%. To actually put $60,000 in your pocket to spend at the grocery store, you can't just withdraw $60,000 from the IRA. You have to withdraw $75,000.
Walk me through why it's $75,000.
Because 20% of $75,000 is $15,000 in taxes. So you take $75,000 out, you send $15,000 to the IRS, and that leaves you with the $60,000 you actually need to live on.
But wait, if I withdraw $75,000 from a $1.5 million portfolio, my withdrawal rate isn't 4% anymore, it is now 5%.
Bingo. You just hit the nail on the head. And a 5% initial withdrawal rate has a drastically higher failure rate historically than a 4% rate. You have literally just walked yourself off the sequence of returns cliff without even realizing it all because you forgot to pay Uncle Sam.
And it gets even worse than that, doesn't it? Because of how Social Security interacts with these withdrawals. This is the tax torpedo that I keep hearing about. Explain how that trap works.
This is genuinely one of the most diabolical parts of the U.S. tax code.
It really is.
Social Security benefits are generally tax-free if your other income is very low. But as your outside income rises, more and more of your Social Security benefit becomes taxable, up to 85% of it.
So if I pull that extra money from my traditional IRA just to pay my electric bill, I am actively increasing my income.
Exactly. Let's say you withdraw an extra $1,000 from your IRA to fix your car. You pay your regular income tax on that $1,000. But that specific withdrawal pushes your combined income metric up, which might cause another $850 of your Social Security benefit to suddenly cross the threshold and become taxable.
Wait, so I'm being taxed on the $1,000 I took out from the IRA, plus I am now paying new taxes on $850 of Social Security that used to be completely tax-free.
Correct. So effectively, you are paying tax on $1,850 of income, even though you only put $1,000 in your pocket to fix your car.
That is just punishing.
It can easily create an effective marginal tax rate of over 40 or 50% for everyday middle-class retirees.
A 50% tax rate for someone making $60,000 or $70,000 a year?
It happens all the time. It is the tax torpedo. And if you don't plan for it in advance, it just absolutely destroys the math of the 4% rule. If you are losing 40 to 50 cents on every marginal dollar to taxes and lost benefits, you have to withdraw nearly double what you think you do just to break even.
So let's synthesize this whole tax problem. If I have $1 million sitting in a traditional 401k, I absolutely cannot use the 4% rule and expect to spend $40,000 a year safely.
You cannot. If you want the exact same probability of success that Bengen found in his study, that 95% safety level, your safe spending power from a traditional 401k is likely closer to 3.2 or maybe 3.4% after taxes.
Because of the tax drag.
Right. If you try to spend 4% net from a pre-tax account, you are actually withdrawing at a gross rate that is a very high historical failure rate. You are redlining the engine right from day one.
That is such a critical distinction for people to understand. A 4% withdrawal from a Roth IRA is mathematically completely different than a 4% withdrawal from a traditional 401k, because the Roth is already tax-free.
A Roth IRA is the closest thing we have in the real world to Bengen's theoretical models.
Yeah.
You pull the money out and it is yours. No friction, no taxes, no torpedoes. But unfortunately, most retirees today don't have all their money in a Roth. They have it in tax-deferred buckets.
Okay, so we've established that the historical data is heavily biased toward the U.S. The sequence of returns in the first decade is the biggest actual risk, and taxes eat a massive chunk of the safety margin.
Yes.
Now let's look at where we actually stand today in 2026. What are the professionals saying right now?
The industry consensus has definitely shifted. We've seen media reports from firms like Morningstar actively adjusting the safe number down. In their recent state of retirement income reports, they've moved the safe withdrawal rate down to around 3.7 or 3.8%.
So the legendary 4% rule is rapidly becoming the 3.7% rule.
Roughly, yes. And that adjustment directly reflects those higher equity valuations we talked about earlier and the shadow of uncertainty over fixed income returns.
The bond market is a wild card right now.
The bond market has normalized somewhat from the zero interest rate era we saw a few years ago, but we still have massive inflation volatility. Morningstar is basically telling people, do not count on the double-digit returns of the 2010s to bail out your bad math.
But there is a counter-argument to this sort of take-a-pay-cut mentality, isn't there? We have the income plus growth perspective. This is the idea that you just shouldn't be selling shares at all.
Yes. Firms like Equity Compass make a very strong argument that the 4% rule can actually survive, but you have to abandon the passive strategy entirely. You can't just buy the S&P 500 and a total bond index and go to sleep for 30 years.
So what is their alternative then?
They focus heavily on cash flow. The idea is to generate that entire 4% via natural yield.
Meaning dividends and interest.
Yeah.
Exactly. Dividends and interest. So you are never actually forced to sell your principal. They look at constructing portfolios of high dividend stocks, specifically focusing on solid yields above 4%, combined with intermediate bonds that kick off steady cash.
So if your portfolio naturally yields 4% in cash every year, you just spend the cash. You never touch the underlying shares, whether the market is up or down.
That is the dream scenario. It completely solves the sequence of returns risk because you aren't selling assets at depressed prices. You are just collecting the rent from your properties, essentially.
But I have to play devil's advocate here for a second. High dividend stocks are not risk-free.
Not at all.
If a stock is paying an 8% dividend yield, usually there is a very terrifying reason for that.
It is often what we call a value trap.
Okay.
A stock often has a huge yield simply because the stock price has recently collapsed and the market fully expects the dividend to be cut in the next quarter.
Right. You're buying a sinking ship.
Or you end up with a portfolio that is heavily concentrated in slow growth sectors like utilities or telecoms, and you completely miss out on the growth of the tech sector.
You preserve your income, but you lose out on total return.
Yes, you might preserve your steady income, but your overall portfolio value lags the broader market by huge margins over a 20-year period.
So you're essentially trading longevity risk for concentration risk.
In a way you are, but for a lot of retirees, the immense psychological comfort of just living off the natural income is well worth the lower total return potential, and they just want to sleep at night.
That makes sense. Now let's talk about what might be the most robust solution of all. If we can't fully rely on a static 4% rule and we really don't want to chase risky yield, we need to fundamentally change the mechanics of the withdrawal itself. We need guardrails.
Yes.
I love this concept because it feels like something you can actually practically do.
This is the most practical modern adaptation out there right now. It moves from a static rule where you spend the exact same inflation-adjusted amount no matter what the market is doing to a dynamic rule. And the most famous version of this is the Guyton-Klinger guardrail system.
How exactly does that work?
Imagine you are driving on a highway. You have a target lane right in the middle. With this system, you actually start with a withdrawal rate that is often higher than 4%, say 5.2 to 5.6%.
Wait, bold strategy, starting higher. So if I have $1 million, I start out taking $52,000 instead of 40.
Yes, you get more money up front. But you have very strict rules. You have a capital preservation rule, which acts as your lower guardrail on the highway.
Okay.
Let's say the market tanks in year 2.
Yeah.
Your portfolio shrinks drastically. To get that same $52,000 next year, you would now technically have to withdraw 6% of the remaining pot.
Which is super dangerous.
Exactly.
Yeah.
So that hits the guardrail. The rule says if your required withdrawal rate jumps up too high, you must take a pay cut. Usually it is a mandatory 10% reduction in your actual spending for the next year.
So instead of $52,000, I drop my spending down to roughly $47,000.
Yes. And crucially, you also freeze your inflation adjustments. You do not give yourself a cost of living raise that year.
That seems incredibly painful, having to look at your spouse and say, hey, honey, sorry, the market is down. We have cut our grocery and travel budget by 10% this year.
It is painful. Nobody likes a pay cut. But here is the massive trade-off. By agreeing to dynamically cut your spending when the market screams danger, you ensure that you essentially never run out of money.
Because you adjust before it's fatal.
Right. Simulations show that if you are willing to be dynamic, if you're willing to actually cut your spending during crashes, the probability of complete ruin drops to almost zero. In fact, a lot of the Guide and Clear simulations often show a literal 100% success rate over 30 years.
And there's an upside to the guardrails too, right? The prosperity rule.
Yes, the upper guardrail.
Yeah.
If the market goes on an absolute tear at the end of the massive bull run of the late 90s, and your portfolio grows so much that your withdrawal rate suddenly drops 20% below your initial target, say your rate drops down to 4% because the portfolio doubled in size.
Then what happens?
You get a raise. The rule says you can increase your spending by 10%.
So you really share in a market's boom and bust. It sounds fantastic on paper, but I really worry about the psychology of it in practice.
The psychological cost is absolutely the biggest barrier. As all the behavioral finance sources point out, no one likes a pay cut. It is very hard to build a concrete budget when you honestly don't know if your income will be $50,000 next year or $45,000.
It requires a lifestyle that is actually flexible.
Completely. If your expenses are all fixed, you have a big mortgage, expensive insurance, high property taxes, you might physically not have the room in your budget to cut 10% without defaulting on a loan.
Which brings us nicely to the bucket strategy. This is less about hard math and more about the mental accounting required to help you just sleep at night when the market is crashing.
It works beautifully because it breaks the massive, terrifying problem into small, manageable pieces. You basically divide your assets strictly by time horizon.
Walk us through the buckets.
Okay, so bucket 1 is pure cash and short-term secure instruments like CDs or treasuries. This bucket specifically covers years 1 through 3 of your living expenses.
Got it.
Then you have bucket 2, which is your bonds and income-producing assets. That bucket is designated for years 4 through 10 of your retirement.
Oh, okay.
And finally, bucket 3 is your equities, your growth stocks. That money is strictly earmarked for year 10 and beyond.
So let's visualize this scenario. I retire today. I have 3 full years of my living expenses sitting in a high-yield savings account or a money market fund. That is my bucket 1.
Right, it's totally safe from market drops.
And then the market crashes 40% in my very first year of retirement. What do I do?
You do absolutely nothing. You just spend the cash that is sitting in bucket 1. You do not touch a single share of the stocks in bucket 3. Just let them sit there and recover. You essentially have a 3-year runway where you don't have to sell a single equity share.
So it physically prevents panic selling. It stops you from crystallizing those paper losses during a major downturn.
Effectively, yes. Ideally, by the time you finally empty bucket 1, 3 years from now, the stock market has completely recovered from the crash.
Does it improve the math, though?
Mathematically, it doesn't necessarily increase your total long-term return. In fact, holding that much pure cash usually creates a bit of a cash drag on your overall performance. But behaviorally, it saves you from yourself. It keeps you fully invested when things look bleakest.
We have covered a lot of ground today. We've looked at the history, the international failures, the hidden taxes, and the dynamic guardrails. As we look at portfolio construction right now in 2026, what else should everyday investors be thinking about? I feel like we have to mention the A word.
Annuities. Specifically, SPIAs, which are single premium immediate annuities.
I know the old saying is annuities are sold, not bought. They have huge hidden fees. They are overly complex. They trap your money.
Many of them are exactly like that. But a SPIA is very simple. It is the most basic form of insurance. You hand an insurance company a lump sum of cash, and they guarantee to send you a monthly check for the rest of your life.
It's essentially a pension that you buy for yourself.
Exactly. If you are deeply terrified of outliving your money, using a portion of your portfolio to buy a concrete floor of guaranteed income can be an incredibly powerful tool.
It entirely changes the equation of your retirement. Because if my basic survival needs, my food, my shelter, my utilities, if those are all covered completely by Social Security plus a SPIA annuity, then the rest of my portfolio is basically just fund money.
Exactly. It allows you to be much more aggressive with the remaining stock portion of your portfolio because your actual daily survival isn't dependent on what the S&P 500 does this week.
You trade liquidity for security?
You trade liquidity because you can't ever get that lump sum back from the insurance company, but you gain longevity protection. It takes that sheer survival anxiety completely off the table.
And finally, I want to talk about the flexibility factor, because it seems like the single biggest variable in retirement success isn't your asset allocation. It isn't whether you own 60% stocks or 50% stocks. It is your behavioral ability to adjust your spending.
This is the critical difference between discretionary and non-discretionary expenses. If 80% of your annual spending is highly discretionary things like international travel, dining out, buying expensive gifts for the grandkids, you are essentially bulletproof.
Yeah, because you can cut back so easily during a bear market.
Right. You just look at the market and say, sorry, kids, no Disney World this year. Grandpa's portfolio is down 20%.
And you survive to fight another day.
You survive. But if 80% of your spending is rigid, non-discretionary stuff, a massive mortgage, huge medical bills, fixed debt service, you are incredibly fragile. The 4% rule is uniquely dangerous for people with very high fixed costs because when the market crashes, they physically cannot hit the brakes.
So as we wrap this deep dive up, let's just summarize the reality here. The 4% rule is not a law of physics. It is not gravity. It is a guideline derived from a very specific, very, very lucky period in American history.
It is a decent starting point, like getting a general compass heading when you're lost.
Yeah.
But it is a very crude instrument. In a modern world of high taxes, sky-high equity valuations, and much longer lifespans, relying on it blindly is just reckless.
The real set it and forget it safe rate is probably much lower.
For a completely static strategy, it is probably closer to 3.2 or 3.3% today.
But if you are actively willing to use those guardrails we talked about, if you're willing to be flexible and adjust your lifestyle, you can comfortably start at 4% or even 5%.
It all comes down to active management of your withdrawal rate. You simply cannot put your retirement on autopilot anymore. You have to watch the valuation levels and monitor inflation constantly.
Retirement planning is not a fire and forget missile.
No, it's piloting a plane. You have to constantly make small course corrections to avoid crashing.
Which brings us to the one question. This is the ultimate question every listener really needs to ask themselves or their financial advisor regarding their withdrawal plan tonight.
The question is, does my strategy have a concrete mechanism to hit the brakes?
Does my strategy have a mechanism to hit the brakes? Why does that specifically matter so much?
Because a purely static rule applied to a wildly dynamic market is essentially a suicide pact. Your survivability depends entirely on your ability to adjust your spending when the market screams danger, specifically in those first 10 critical years.
Right.
If you don't have a mathematical plan for when and exactly how to cut your spending, you don't actually have a plan. You just have a hope.
Powerful stuff. The ultimate goal isn't just to not run out of money, right? It's to efficiently use the capital that you spent a lifetime building up. You don't want to be the person who starves while sitting on a pile of gold, but you also don't want to be the person who falls off the side of the mountain because they simply refuse to slow down when the weather got bad.
Well said.
And think about this too. What if the goal isn't just dying with zero, but actively optimizing the utility of that capital while you are still young enough and healthy enough to actually enjoy it? That changes the math entirely.
It really does.
This has been Talk Tickers. Usually we tell you to watch the tickers for the stocks you own, but today we are telling you to watch the ticker for the single most important asset you have, which is your future. Keep your eyes on the tape.